Well, hello, everybody. I'm Mark Gabriel, Chief Fintech Strategy Officer at Sunrise Banks. And 2020 has certainly been full of surprises. I never imagined that I'd be attending my second Fintech South conference remotely, but I've been really impressed with the level of engagement and all of the conversation that's been possible in this new format. And I'm really happy to be here with a great panel to discuss a topic that we care deeply about here at Sunrise Banks. Before the pandemic or calls for social justice or this election, basically 2020, Americans were heading into the year living paycheck to paycheck. And a large percentage of them, somewhere between 40 to 80%, that number is just enormous, didn't have enough savings to cover 1 month of living expenses, let alone unplanned emergencies. In the next 40 minutes, half hour, we're going to talk about some of the challenges of affordable credit. And I'm joined by an A-list panel. Literally, their names all start with A. And shortly, I'll turn the mic over to them and we'll talk about this important issue. Before I do, I just wanted to share just a little bit more about Sunrise and why we care so much about this problem. We like to say that Sunrise Banks is a social enterprise that just happens to be a bank. We're headquartered in St. Paul, Minnesota. We're a certified B Corp, so we measure our impact as much as we do revenue. We're also a community development financial institution, which means we deploy at least 60% of our loans to low to moderate income communities. More simply stated, we believe that business can be a force for good, and we're on a mission to positively affect 250 million lives by 2028. We believe in responsible innovation, and we believe that fintech can help extend affordable credit through the employer or directly to consumer channels. And as I said earlier, I'm joined by a stellar panel. And I'd like to turn the mic over to them to give them an opportunity to introduce themselves. Anish, can I start with you? Can you introduce us?
Yeah, can you hear me? Hey, Mark. Hey, everyone. Thank you for having me. I'm Anish from Andreessen Horowitz. Prior to A16Z, I was at Credit Karma. Prior to that, I'd been a founder a couple of times. So you're really excited to be here. It's a topic that I'm passionate about and I've had some experience with. So excited to be here with all of you.
Amanda, could I turn it over to you, please?
For having me. Excited to be here. My name is Amanda Flashner. I am the Senior Vice President of LendingPoint. LendingPoint is located in Metro Atlanta, and we are a data and technology lending platform founded in 2014. We originated our first loan in 2015, and 5 short years later, we've originated $2.3 billion and have over $1 billion of assets under management. We also have partnered with over 3,000 small businesses, e-commerce, and merchant partners to help them grow their business by providing their clients, customers, or patients with payment plan options. Something, as you are probably aware of, has become an even bigger part of our business during the last 8 months and has grown our passion and mission to help these individuals.
Thank you. Anita.
So first, I'm delighted to be part of the A team, and Mark will make you an honorary A for the day, okay?
I like it.
So my name's Anita Ward. I'm the Chief Development Officer for Salary Finance. Salary Finance is a fintech. We were launched in 2015 in the UK. I'm part of the US team, but our goal is to move working Americans and working folks in the UK from debt to savings. And we do it with a salary-linked model that allows us to be inclusive around lending and savings and affords us the opportunity to integrate many more people into access to credit that have been marginalized for years. So in the US, altogether now we have 3.5 million people using the platform, about 550 employers, and we're growing every day. And COVID has definitely been a catalyst for some more of that growth this year.
Awesome. Well, thanks everybody for introducing yourself. I guess as we look at 2020, it's just been a year of unprecedented uncertainty. And traditional lenders like banks, we typically look at FICO scores to figure out the relevance of a borrower's creditworthiness and ability to pay back. Amanda, as we look at these uncertain times, what kind of creative approaches can lenders take to understand borrowers during COVID 2020?
Yeah, I think FICO, it'll always have its space in credit models. They recently actually released the pilot of their resilience index to help provide lenders with additional insights on consumer resilience during these times and potentially future times of sorts. But for us at LendingPoint, traditional FICO scores, it's only ever really been a small percentage of our credit models from the very beginning. We have a very niche type of consumer. FICO score didn't really tell the right story for them to unlock the access to credit that they deserve. So we found success really using alternative data and propensity models. We've always focused on gaining a deep understanding of our customers, not only who they are, what they need, and how we can be of personal value to them, but also what is their current and potential future cash flow positions. This level of understanding has allowed us to maintain our goal of lending responsibly, something that we're very passionate about. The last thing we ever want to do as a lender is overextend our customers. During this time period, something we've always had is a robust employment and income verification process. It's always been part of our ethos, but during the last 8 months, I would say even more so. And depending on their niche, other fintech companies really weren't using those type of verification processes. And for most of the part, ours are all online and automated, so very easy for the consumer to go through that process. This process not only helped our consumers get through the application process and unlocking access to credit, but it allowed us to come out on the other side profitable and back to our pre-COVID origination, even after 2 months of slowdown, as you know, in April and May. So this has also allowed us to come off our second best month of the year. We're hopeful that we are starting to recover and optimistic in the resiliency of consumers. FICO and the credit bureaus are going to have a lot of work to do to get back to where they need to be. But we're definitely watching the FICO Resiliency Index and going to see where that's going to go. It's in pilot stage right now.
That's a great way to use alternative data. And we're starting to see more moves within the industry where they're starting to attribute payments towards cell phones and rent and things like that. Anish, as we see more data available, are you finding that entrepreneurs are finding ways to extend credit to thinner filed customers?
Yeah, definitely. I mean, I think one story that hasn't been told here is that a lot of consumers are actually in better shape than they were in 2008. And if you look at sort of rates of savings, if you look at how much equity people have in their homes, it's actually a lot higher than it was 10 years ago. And we entered this crisis with the consumer in at least better shape than they were previously. So I think there's a little bit of good news. I think related to that, the more that we can lend against some of those assets which may be less visible. I mean, a high income sort of low debt consumer, or one that doesn't have a long age of credit history, is a great example of someone who we probably do want to underwrite, but is somehow invisible to the FICO based system. So yes, I do think founders are starting to look more at this. I do think there are challenges to scaling in terms of how do you sort of securitize debt that's not based on models like FICO. But I do think there's more of a sort of misscoring problem than anything else in the industry, and companies like LendingPoint are clearly addressing that.
Yeah, no question about it. I guess as we look at the challenge, is it just, Anita, as we look at this challenge here, is it just a U.S. phenomenon that we have so much need for credit, or is it more of a global concern?
Well, it's definitely a global. It's a global issue. But it's interesting, Mark, when you raise this question, because I'm a cultural anthropologist, which a bit of a duck out of water since my career has been predominantly in the financial services sector. So I've been arguing for years to move to a behavioral economics-based modeling and really take a look at some of the untraditional variables that go into decisioning. And so at Salary Finance, we don't use FICO score as the driving factor. We use interesting things like tenure and ability to repay. And so we're taking this much broader look into it. And each one of those attributes gets a much higher weighted value in the decisioning than something else. But I saw this research, and I just have to share it. And I guess you'll get used to me, but I saw this fascinating research, and we're in a fintech conference, so we should get way out of the box, right? There were some researchers who did a study of people who were online shoppers at Wayfair, and they were applying for credit to complete an online purchase. Have you seen this data? So cool. So what they did was they looked at 5 very simple digital footprint variables. And they compared these variables to a traditional credit score model in predicting who was going to pay back a loan better. And they're crazy variables. One was borrower type of computer, Mac or PC. Another one was type of device. Was it a phone? Was it a tablet? Was it a PC? Another one was the time of day you applied for credit. Like borrowing at 3 a.m., not a good sign, right? The fourth one was your email domain. If you have Gmail, it's a better risk than Hotmail. I guess I told you that, right? And then is your name part of your email? Because names inside of an email are a good sign. They did this research, compared them, and those 5 digital footprints outperformed in paying back the loans over every credit model. It's fascinating. I mean, it's probably illegal. It's definitely probably unethical, because
definitely illegal.
Right? Definitely illegal. Did I say probably? Sorry. That's why I'm no longer in banking. No. Should a bank be able to, lend at a lower interest rate to a Mac user? It's even if you control for everything else. Obviously, that's not the case. But there is so much fascinating research going on around credit modeling, behaviors, new variables. There are some amazing companies and academics challenging this. So I'm repositioning the question in my own head about not to draw the line so much on what can be used maybe, but where's that line drawn so it's clear what new types of data are and aren't permissible, and how do we use it? I mean, I think this could really inform policy, but I think thinking way outside what we as traditional bankers think of is going to drive innovation in our own minds. And I don't want you guys to walk away saying Anita suggested that we should lend, I will get fired based on a digital footprint. But I think there's certainly things at a tech conference that we should talk about.
Yeah, absolutely. And as we all have one of these in our pocket, how much are they going to help or hurt us as we look into the future? And as we talk about some of the legalities of some of that additional data, I guess, does having that data extend our ability to offer credit to folks that were disenfranchised before, right? So fast. So Amanda, I'm just curious, and I know that you're kind of expanding that envelope, and obviously you can't go as deep, but just very powerful technologies in and on us and around us to keep expanding our credit footprint. As we look at this pandemic, and we look at its claim towards, it's claimed over 210,000 lives and disrupted millions of jobs, and that burden really hasn't been shouldered equitably across the American society. And you talked about that a little bit, Anita, and how we can pull in some additional data. But I'm wondering, Anish, when our entrepreneurs, what are they doing to kind of look at the space and address some of these inequalities that exist within our economy?
Yeah, look, I think that education is generally the wrong approach. I think there's like a judgment that's implied by education. There's that whole thing of maybe you shouldn't be drinking your Starbucks, which I hate. Generally, I think we need automation. Like, people want someone to go to the gym for them, if possible. And look, I think that's why teaching new habits can be great for a subset of the population. But ultimately, the more you can use technology as leverage to automate some of these good decisions, the more that you actually can get impact at scale. Because I think the biggest challenge is, it's less an access problem and more a behavioral psychology problem. And I think a great example of this is, you look at Mint, for example, versus a product like Digit. Mint's the product that tells you overspent on, restaurants this month. And it's like, well, I like to go out to eat. What do you want me to do? It's easier to uninstall Mint than it is to stop eating out. But Digit is just a product that makes it invisible. Like, you don't change your life at all. Somehow you build savings. So I just generally think playing offense on some of these sort of good behaviors versus nagging is a much better approach. And that's something that's showing success at scale.
Yeah, that's amazing. Anita, is there a role that employers can play?
Oh, of course. I mean, I think that's part of the question that Anish was talking about. How do you get to scale?
Right.
We clearly aren't going to get to scale unless we have employer buy-in and the workplace buy-in. But I'm seeing a couple of interesting things. So I am terrible about it. I have a nutritionist who will tell me what to eat, much to Anish's point. I can listen, you can educate me, you can tell me, I could get on Noom, I could snap a, whatever, rubber band, whatever those things are. But until the blue apron box with all of the right good food in it arrives at my door, I'm not likely to do that. And I take that metaphor into our world, because financial coaching and financial curriculum on their own just aren't going to change where we are. What we really need are tools, whether those are access tools to make it easy to borrow or savings tools that make it easy to save. And it's the technology that has to align with the social piece that makes this almost a natural behavior, right? So back to my anthropology days, it really has to fit, and it has to be a tool. We've talked a lot in the workplace about check that box, we have financial literacy curriculum. Well, I argue that it's really quite a different effort to bring forward tools that make a difference versus just teaching the language of money. And of course, we have to remain empathetic and culturally integrated with what we're trying to do. But at the same time, people need tools, and that's how they're going to make it happen. One of the most interesting shifts I'm seeing, though, Mark, lately, I find it fascinating, and maybe it's an alignment with civil unrest, but in many organizations, there's a shift of positioning financial well-being as a DEI initiative. So taking it into a place where we're challenging conventional thinking, really using financial well-being as a way to address inequalities in the workplace. It also, in my mind, starts to force these authentic conversations where financial discussions are safe. So there's a different approach, I believe, from DEI professionals that are really quite different. But I also think I'm going to have bankers on this panel with me. I mean, yes, the workplace, of course, is important, and we sell into the workplace, and that's how we reach all the people. But the banks are best positioned to address the inequities and provide broader inclusion to capital. Right? We're seeing it with some of the money center banks. I just saw PNC's announcement yesterday. I mean, they're doing some really sexy things to take financial well-being to their corporate clients and helping the employees of their corporate base. I mean, it's really quite interesting, and I think that the more that people like Tasunda Duckett at JP Morgan and others challenge this and make investments in tools and open those doors to inclusion, then I think the banks are best positioned to help us with this. Although the big banks can't dance, they're still giants and they still can't dance. But at the same time, I think they're best positioned to do this should they decide to dance.
Sounds good. And as Amanda, as we look at fintech, they play a big role in this as well, right? It's not just banks that can come to come in on the white horse. Amanda, any thoughts on that, on fintech's role? And
well, yeah, I think fintech has an important role in it, right? One of the best things about fintech is that we are agile, and it's a tool. Like Anita's point, it's a tool that we can make borrowing easy. What you've seen in some of the disfranchised neighborhoods, you see lending institutions they fled many of these neighborhoods. So they're reducing access to credit. They're actually creating what we call like credit deserts, where all of a sudden there's no access to it. There's no brick and mortar. They're gone. There's no banking. There's no borrowing. So what we can do as a fintech lender is, and what we have done is, and this is where we kind of live in the space, is we really step up and we become the kind of anywhere and everywhere borrowing experience, whether it's online or it's even by phone. And yeah, of course you can come walk into our office. It happens very rarely, but we're always really happy when we get an opportunity to meet one of our customers. But I think that's where fintech can continue to close that gap.
Awesome. Anita, earlier you talked about people opening up about their financial situation. I think we've all read the article in The Atlantic about the people's reluctance, Americans' reluctance to talk about their financial position. And it's kind of the shame that goes along with being in debt, if you will. Has the pandemic, or how has the pandemic really provided an opportunity for people to talk openly about finances? Are they more willing to discuss it?
So you would think, given that the propensity of news stories, and you can't pick up social media or look at anything without a discussion of this, that in fact the taboos have gone away. But I'm going to remind everybody on here of that old folk tale, the emperor's new clothes, right? The emperor He loved clothes, and so some unscrupulous tailors came along and said, "I'm going to make you the most precious fabric. It's, lightweight. It's like a spider web, and only people fit for their roles will be able to see it." And so this emperor puts it on and parades through town, and the whole town saying, "Oh my God, the robes are beautiful!" And then some young child calls out, "The emperor is naked." Well, I share that because in many ways, while my answer should be yes, the pandemic has really given us the momentum to have these authentic conversations and openly discuss this in the workplace, that my answer truly is that the emperor is still naked, right? So we think it's there, but the stories like that vice president who felt compelled to reach out to me on LinkedIn because she was too embarrassed to deal with it in her office. She felt like she would be considered less of a leader if she shared her fragility, her economic fragility, despite the surrounding situations. I had an interviewer 2 weeks ago, when our interview was done, said to me, "Are you kidding me? I'm not going to go to my workplace and tell them that, in the midst of layoffs, furloughs, taking away 401k matches, cutting expenses, that I'm economically fragile. I want to keep my job." So I think with this rising anxiety, rising depression, rising issues around mental health, I don't know, maybe all of you are different, but I would say many people ask themselves every day, how secure is my job? How secure is my employer? People are feeling anxious around this. So I think that this whole idea of financial stress should open the conversation and should create a sense of urgency, but I'm not seeing that across the board. There are lots of surveys done, and one of the most recent ones I saw said that only 7% of employees feel that they could talk openly to their employer about money problems. So I don't think that it has shifted that still sort of deeply embedded taboo of being open in the workplace about your economic position, even though I do believe employers are saying honestly and openly, financial well-being is important. And I do believe there's a sincerity in that. I just believe that there is a corporate culture and value systems and things that we need to overcome in order for people to feel that they can communicate their money worries. And so that's why I think that some of the organizations that are using this approach through the DEI world to socialize it internally, to socialize financial well-being, is really kind of interesting in the approach to break down walls and to let people feel safer and more included in this financial well-being discussion.
Sorry, Anita, what is DEI?
Oh, I'm sorry, diversity, equity, and inclusion. Thank you for asking me. I shouldn't have used that, an acronym. I apologize. So the diversity and inclusion professionals really approach the workplace from a very different perspective than other professionals. So in fact, I always joke about it. Well, we're making Mark an honorary A. I'll make everybody an honorary cultural anthropologist, because it's a different empathetic kind of approach. And it's looking at creating safe spaces around finances. And I didn't grow up in a household that talked about money. And I think many people haven't. So it's almost it's an uncomfortable conversation, particularly in the workplace. So as I see other organizations beginning to do this at Salary Finance, we've aligned with that initiative. PwC has a great initiative called CEO Action for Diversity and Inclusion, and their financial services group is driving a lot of the thinking around financial well-being in the workplace. And to Amanda's point, how do you get these vulnerable populations? How do you reach them when they're either unbanked, underbanked, credit invisible, have no savings, and then you throw in the wealth gap between African Americans and Hispanic populations and white Americans, and it's 17,000 versus 171,000. So when we think of resilience and how employers have to step up and into this space, then as much as I joked about the banks, it wasn't a joke. I do believe the banks are best positioned. I just don't think they'll be able to pull it off. And that's where Amanda's talking about the Fintechs coming in. They're understanding D&I. They're understanding that we have to be flexible. They're understanding that this has to be different, and it has to be a tool, and it has to be immediate. So, you guys are going to get me on a soapbox. So back over to you, Mark.
I guess, Mark, if I could jump in, Amanda, I'd be curious to hear from you or Anita, what would you sort of say to the idea that perhaps there's misalignment between lenders and borrowers, and while it's great to provide access to credit, it may be insufficient to solve the longer term challenges your customer faces?
Yeah, I would completely agree with that comment. Yeah. We have a responsibility, but kind of like Anita said, like, education only goes so far. You said education only goes so far. So yeah, I mean, we can help with the short term, but the long term changes of that is something that, as a lender, it's something that we struggle with. We want a relationship with our consumers. We want to help them. We want to be part of their financial wellness, and we want to be, as we joke internally, the hero to them, right? How are we the financial hero to them? Well, there's only so much at times you can do as a lender legally, right? Mm-hmm. That's a huge issue we run into all the time. So Anita, I'm voting for you to go up on Capitol Hill and start having conversations on our behalf, because there's so much you want to do as a lender for your consumers, and then sometimes you're just so tied to what you're legally allowed to do, and sometimes that is actually the disadvantage to your consumers, and it's a tricky place to be in. I mean, we deal with it all the time in customer experience. There's things that we want to do that we know would be helpful for them, but we just can't. But I will go back to the comment about talking about financial wellness. As a lender, what we have seen during this pandemic is actually an outreach from our consumers, letting us know that they're having a hardship. Before, it would have been maybe a little bit of a stigma for them to reach out to us and say, I lost my job, or I'm going through a significant hardship. Because the pandemic was so widespread and it affected so many people, we had people raise their hands and said, I need support. And that's what we were able to step in and provide for them, and figure out what is a strategy to provide them a short-term solution with long-term good financial impact for them. And I think as a lender, because that relationship is, I don't want to say transactional, but it can be, and that's okay. But because it is transactional and they did not want to fall behind, and it was dominating the news, they were very, very eager to reach out to us. And we were obviously eager to help them. And it totally changed, actually, I think, the trajectory of our current hardship program moving forward, which is a great outcome to all of this.
Yeah, I was just on another panel or fireside chat, whatever, with Equifax, and the data is compelling. Like, delinquencies are down because of, and credit card utilization is down. Back to your point, Anish, I mean, people are, it's an all-time high in the second quarter for American net worth, right? People are in a better place going into this. So we should be able to take that bounce and figure out, how do we now start to layer in resilience versus just access to credit? What does resilience look like? And what does that look like as people weather financial shocks? And if you look at LMI populations, you'll see that the access to predatory lenders, or the access to expensive credit, happens seasonally. The Financial Diaries did a beautiful job outlining that data around the beginning of the school year and the holidays. And then what we see now is, in March, credit card utilization went up. I jokingly say people were buying toilet paper, but it went up among young workers, and went up in Hispanic and African American and low income earners, which tend to be aligned anyway, right? So in March, it went up everywhere else, and every other single demographic went down. Utilization's down. Borrowing's down. People are paying down debt. So student loans, right, with all of the when all of the accommodations went in place for student loans, that put on average $270 back into people's pockets. I thought they'd be like me and spend it on Amazon, but instead they're paying down debt. So it's a fascinating piece that I agree with Anish. It should not be overlooked that some significant change, tectonic change, has occurred in consumer behavior, and that if we can parlay that, we can create interesting programs around resilience, because I think the data is letting us dive deeper than ever. So there's the fintech piece, right? I mean, we need to be open, sharing, open sourcing data. We're not going to solve this problem without understanding the data and the movement within the data.
Fantastic. That's it's definitely going to take all of us kind of putting our heads down to find solutions, and there's definitely some silver linings out there, right? It's not all about the bad news.
Yeah.
So that's good to hear. As we look forward to the time ahead, the government's played a really big role in its response to COVID. It's provided, stimulus checks to consumers and PPP loans to businesses. We've really been focused on that consumer angle. But outside of the government, are there other ways to get liquidity into this market? And I'll just kind of throw that out. Yeah.
Well, I mean, I think one thing is just how effective has the government been in sort of driving discovery and awareness of what they have. I mean, I think that it's a new space that I've been curious about for a while, and it's really come to the forefront in COVID, which is the government has a distribution problem. There needs to be an interface between the government and its citizens, because even if you look at, for example, student financial aid and bursaries, there's this huge underutilization, and all the headlines you read are about this huge need. So it's a funny market inefficiency where there's value to be had, there's an individual who can benefit, and they just don't know. So anyway, I know I'm not answering your question, Mark. I think there are roles that other institutions can play, but I do think the government is sadly underutilized, and tech can help citizens navigate that.
Amanda, any thoughts on that?
I mean, the liquidity question, for us as a lender, it's how do we get more liquidity to provide more liquidity, right? And you also have a government program as well. The TALF program that came out and that was helping during the Great Recession. Well, Fintech wasn't even part of it, and we're still not part of it. We've been working to get part of the TALF program, because the more they're buying bonds, the more the markets open up for us, and that way it actually offsets our liquidity so that we can get more liquidity to give out to the consumers. So there's a huge government issue to it that has nothing to do with stimulus, and it's how it's all actually interconnected. So the TALF program is something that we're working on, hoping to get Fintech part of it soon.
Fantastic.
How about you, Mark? Are you seeing things at Sunrise Banks? Do you guys, are you addressing the liquidity issues with the bank, or have some thoughts? I know you guys do some amazing stuff, and I'm, what are you looking at? Love to hear you weigh in on that too.
Well, we've certainly been active in the disbursement of the PPP loans, right? Banks did play a major role in that. And we're really happy to play a role locally here in the Twin Cities and deploy that much needed capital to businesses. And as we look at the future, we really see a great opportunity to work with Fintechs because they work at such great scale, and because they work outside of our lending area, right? Like, we can work on a national scale versus very hyper local in the community here. So we are looking for ways to partner with Fintechs to get capital out for consumers as well as businesses. And I know we have just a few minutes left on the panel here, so certainly open it up to questions. We can monitor for questions on the chat, but I guess maybe we can just kick it around the horn here and just ask what you guys see on the horizon for 2021. Maybe Amanda, can I start with you?
So my eyes got really big right there. Yeah. It's hard. All I know is this, right? Is I think from my organization standpoint is we've really kind of proven ourselves. One of the things with the fintech industry, we always had this question looming over us, which is, do they have staying power? Can they really do this? Most of us weren't around during the Great Recession. So I think 2021 for fintech lenders, it opens up a more doors for us because we've proven it. You've seen some consolidation in fintech for business lenders, but not for consumers. We've been able to figure it out and stick with it. I think also organizationally and culturally, which I think will be really interesting, is those organizations that did not have a work from home policy in place prior and always the balance of work-life balance. I'm trying to figure that out. I think this has really opened up the doors to proving to companies that even when you have a call center that's as large as ours and we weren't prepared, in January, we were not prepared to go all the way work from home. We were able to do that pretty quickly. So I think in 2021, I think for fintech organizations, you're going to see a shift culturally, which is a good thing. I hope as I guess a country that we have seen the resilience of each other, and we'll be able to continue through that. I'm also very curious on how, one thing as a parent in all of this, how much schools are, the economy relies on schools. If school's not in, how do we do this as an economy? That's a huge thing that we got to fix. I don't know if all four of us right here can fix it, but it's something that has definitely come to light is when you have working parents and they can't get into work, it drags on the economy, and then the only solution to that is schools. I'm not sure about that, but yeah, I think 2021 will be interesting. We're definitely not going to be the same for a while.
Anish, what's your crystal ball saying?
Yeah, no, I don't think we're ever going to be the same. And I think that's exciting. You know, I think we ran an enormous global experiment with something that just wouldn't have been tried by most companies. And so I think like the nature of work is what's going to change most. There's sort of been this interesting dichotomy where, you know, the next generation wants more flexibility, and so do employers. You know, employers don't want employees for, for lifelong anymore necessarily. And there's been a bunch of awkwardness around that. You know, most traditional employers don't want to hire remote or international. And now all of that stuff is being taken for a test drive. So I think the big things that's going to change in 21, well, one, it's going to be the year of the cure, hopefully. But two, it's also just the way we work, because even when we are post-COVID, I just don't think it's going to go back to the way it was.
Absolutely. Anita, we have a couple minutes. Anything that you see on the horizon for 2021?
Yeah, I think we're going to see some unexpected partnerships. And so one comes to mind. There's an organization called One Mind Garen Staglin's the CEO. And they have all kinds of mental health programs that they're working on in the workplace. And now they've teamed up with Bank of America to start to lead some integration between mental health and financial health, and really sort of doubling down on their commitment to interesting programs. So I think you'll see more and more of these, or we'll see more and more of these unexpected partnerships. And then I think we're going to see some acquisitions. I think that a lot of the fintechs are probably ripe for acquisition by some of the larger banks. And I think we'll see investment dollars that are I think steered more toward financial well-being, more toward well-being. And I think we're going to see more banks like PNC and others moving into that financial well-being market, much like Truist Momentum has done, and others. So yes, I agree with that everything's going to change. But I think change is lovely. If you can't tell that about me by now, I live for change and chaos. And I think this is one of those opportunities where we're going to have all kinds of new business opportunities on the horizon, strange bedfellows, interesting acquisitions, investment dollars going into fascinating cultural places. And I think 2021, I'm incredibly optimistic, and I can't wait to be a part of it.
Yeah, no question about it, right? Chaos always creates opportunity, and it'll be interesting to see what pops out of this. I think if anything has happened during this pandemic is just that we've got a little bit more resilience, and we have this level of authenticity as we meet each other from our homes with our daily, just, children running around if you're blessed to have kids, and there's just this level of authenticness within society. And as we look at financial wellness, it sounds like we have a broader view of what's makes someone financially well. I want to thank all of you for contributing on this panel. I open it up for any other questions from the audience, but I think we're right at time here.
Thanks, Mark.
Thank you, Mark.
Thanks, Amanda, Anita.
Thanks, guys.
Nice to hang with
Wonderful.
you. Let's do it in person
Thanks.
sometime.
See you soon.
Next year in person. That's the
Next year.
2021.
Definitely. Same place, same time, huh?
Exactly. Thanks, guys. See you. Bye-bye. Thank you, Mark.
Bye. Thanks, Mark.